Good afternoon, and thank you for your time. My name is Juan Alemany, founder and managing partner of Alemany Growth Partners. Today, I want to present Fund First, a growth equity fund investing in the software companies that make artificial intelligence actually work in production, the data compute and deployment layer, across the US and Southern Europe. Over the next 6 minutes, I'll cover the opportunity, how we invest, how we construct the portfolio, our return targets, and the terms of the fund. First, the fund at a glance. Alemany Growth Partners Fund First is a $250 million growth equity fund, hard cap of 300, making minority investments of 15 to $30 million in 10 to 12 AI data infrastructure software companies. In the US and Southern Europe, we are targeting a 20 to 20% net IRR and roughly 2.5 net multiple on invested capital. On my background, I spent 8 years in growth investing, most recently as a principal at Bacon Growth Partners in Boston, and before that at Iberia Ridge Capital in Madrid. I led 9 investments in this exact space, three of which have been realized at a 3.4 average gross multiple. That experience, plus a sourcing network across Spain and Portugal's engineering hubs, is the foundation of this fund. Why this strategy and why now? Global spend on AI infrastructure is projected to grow from roughly $47 billion in 2024 to over $300 billion in 2032. Yet less than 15% of world states' AI capital reaches this layer. Most of it chases consumer applications. And in Southern Europe, comparable software companies trade at roughly half the entry multiples of their US peers. Our edge rests on three pillars. First, picks and shovels. Infrastructure vendors monetize every AI use case, so we don't have to pick the winning application. Second, transatlantic arbitrage. We source at European valuations, help companies scale through US go-to-market, and exit to US strategic buyers. Third, revenue quality. We only buy usage-based, mission-critical contracts with a net revenue retention about 120%. What exactly do we buy? Four segments: data platforms, think pipelines, vector databases, observability, compute, and MLOps, deployment and inference optimization, connectivity, the API and integration layer, and trust and security, model governance and compliance tooling. And the company profile is disciplined, $8 to $30 million of ARR growing, at least 40% a year, software gross margins above 70%, net revenue retention of 120% or better, and a clear path to profitability. Headquarters in the US, Spain, Portugal, or Italy. We take 15 to 30% minority stakes and we take a board seat in every single deal. How do we create value? We underwrite operational growth, not leverage, and not multiple expansion. Four repeatable levers. One, US go-to-market build-out. This is the biggest lever for our European companies. We stand up the US sales motion and target 2.5 ARR within 3 years of investment. Two, talent. We recruit VP of sales and CFO level operators from our network within the first 2 quarters. Three, operational excellence, pricing, retention, and cloud cost work that lifts gross margins 3 to 5 points, aiming at rule of 40 by exit. And four, strategic positioning. We build the exit map at underwriting, not at year 5, including partnerships with the hyperscales, who are the most likely acquirers. Portfolio construction. 10 to 12 platform investments with initial checks of 15 to $30 million and 20% of the fund reserved for follow-ons into our best performers. No single company exceeds 20% of committed capital, roughly 60% North America, 40% Southern Europe, balanced across our four segments, deployed over about 4 years. Critically, no leverage at the fund level, and our companies carry little or no debt. Returns come from revenue growth, not financial engineering. Our targets: 25 to 30% gross IRR, translating to 20 to 25% net. 3 gross multiple, roughly 2.5 net. Every deal is underwritten to a 3 base case on growth alone, and we assume one impairment per fund in our loss ratio. On exits, we map the exit before we invest, not after. The primary path, roughly 60 to 70% of expected exits, is strategic M&A. Hyperscalers, data platforms, and enterprise software consolidators are the natural acquirers of AI infrastructure, typically in years 3 to 5 of each hold. The secondary path is sponsor to sponsor. Once our company scale past 75 million of ARR, large cap growth and buyout funds become an active buyer market, and selectively for two category leaders above 150 million ARR with Rule of 40 economics and IPO. Always runs as a dual track to preserve optionality. Finally, the terms. Deliberately institutional and LP friendly for a first time fund. A Delaware limited partnership, 250 million target with a 300 hard cap. I'm personally committing 2% of the fund. Standard economics, 2% management fee stepping down to 1.5 on investment capital after the 5-year investment period. 20% carried interest over an 8% preferred return. Importantly, we use a European whole of fund waterfall. Carry is only paid after LPs receive all capital plus the preferred return, and full ILPA aligned, reporting with an LP advisory committee. Close, the application layer of AI gets the headlines, but the infrastructure layer gets the cash flows. Alemany Growth Partners Fund First gives you disciplined, growth-driven exposure to that layer and attractive entry valuations, with alignment built into every term of the fund. We're targeting a first close in the fourth quarter of 2026, and I would be delighted to have you as a funding limited partner. Thank you very much for your time. I look forward to your questions.